Wall Street Week with Louis Rukeyser is made possible by the financial support of viewers like you and by Prudential Beach Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, December 29. Our panelists are Frank Cappiello, Mary Farrell, Monte Gordon, and Martin Zweig.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. And wow, what a year. And what a decade. Tonight, as we gather here for our 20th annual New Year's Fun Fest, an orgy of self-flagellation, a tradition in which we review the events of the year just past and then heartlessly compare them to our panelists' predictions of a year ago, I want to begin with a highly unfashionable toast. Here's to the optimists. Now, I realize that by uttering those scandalous words, I risk losing my lifetime press card, not to mention my status as an authentic media commentator. So let me hasten to make clear that I'm not going soft on you. I hail the optimists not because they had more fun than the gloomy Gusses, which, by the way, they always do, but because this time they also happen to be astoundingly right. In an era when hate and doubt and pessimism were all too prevalent, this was the year, and the 1980s were the decade, when we wound up, to the stunned surprise of the downbeat consensus, with an array of the most amazing arguments for faith and optimism since Rebecca of Sunnybrook Farm. Let's start with the state of the world. A decade that began with the West reputedly in eclipse, with Americans held hostage, not just by a loony Ayatollah, but by their own consuming malaise, ends with freedom ringing throughout Eastern Europe, and with even the militant Marxists of Beijing trying desperately to figure out how they can simultaneously save face and make a deal with the capitalists. If you predicted all this, even a year ago, you'd have been laughed out of the consensus. Or take the American economy, which hardly anyone wanted to do early in this decade, when the U.S. wallowed first in horrendous inflation, then in the worst recession in half a century. If you'd predicted in November of 1982 that the U.S. would immediately launch the longest peacetime expansion in the history of the Republic, putting a record percentage of the population to work and extending unbroken right into the 1990s, why, they'd have put in a call for the nearest psychiatrist. And finally, there was the stock market nobody loved. Throughout this bizarre decade, public attention focused on one quickly discredited financial guru after another, each one destroyed in the end by his eagerness to predict spectacular disaster and decline, each one playing on our innermost fears and insecurities, and each one, in the end, abysmally wrong. They owe us an apology. Anyone who followed their advice probably owes more than that. For tonight, the Standard & Poor's 500 has just completed its 8th straight up year. Do you know how often that has happened before? It has never happened before. Those who kept the faith and ignored the pessimists were the big winners of the 80s, financially and otherwise. Year after year, the bears grabbed the headlines, but the bulls made the money. This exciting year alone, a year when much of the financial press again was dominated by forecasts of the apocalypse, the Dow Jones Industrial Average wound up gaining more points than in any other year in its history. Optimism paid in every way. Does that mean that this market that has now been up for 8 straight years will now be up for 80 straight years? I wouldn't count on it. And so tonight, having appropriately hailed untrendy optimism as the winning philosophy for the 80s, we will ask 4 of our best panelists to come up with the winning philosophy for 1990. Let's hope that their advice will be as excellent tonight as it was for 1989, and that we'll all have new reasons to smile 12 months from now. The Dow Jones Industrial Average ended 1989 with its third straight week of advances, to finish at a higher point than it ever reached in any year before 1989. For the week, the Dow added nearly 42 points to close the year at 2753.20. And all the broader indexes joined in to give 1989 a big finish, notably among the recently neglected smaller stocks. But there's been one defection among our chief elves, whose index slipped a notch to a still bullish +3, as Bernadette Murphy moved from optimistic to neutral on the next 3 to 6 months. Gold and silver lost ground, still unable to extend their recent mild snapbacks. But the big news was in the bond market, which faltered as interest rates rose abroad, weakening the dollar. And as the persistent, if sluggish, growth of the U.S. economy cast further doubt on predictions of early recession or even of enough softness to encourage a rapid easing of monetary conditions. Frank Cappiello, is all the good news behind us now in the bond market?
No, on the contrary, I think we can look ahead, certainly over the next year, in 1990 and 1991, to a better bond market, because interest rates will be coming down. And that's always good for the bond market.
It took a particularly bad one-day hit this week as people worried that the dollar wasn't going to be so strong.
Right.
Is the dollar less attractive to foreigners now than it was a week or two ago?
The dollar is, people are perceiving that lower interest rates will hurt the dollar. And all I can do is point to the yen, point to Japan. They have lower interest rates, and the yen has been a strong currency over the years. So interest rates are only one factor that relates to the dollar.
What do you make of the mood of the market at year end?
Well, it's the usual cut and fill mood, Lou, where we have a lot of institutions that are trying to fill up their roster, trying to fill up their portfolios. But I think the most significant thing that's occurred this week has been the Japanese stock market. It hit another new all-time high in the face of the third straight discount rate increase. 3 steps and a stumble.
If we were optimists in America, what were they in Japan?
They must be mad. They must be going crazy.
I've been hearing that for years, but it keeps going
I know.
up. Is this someday going to end?
The 3 raises of the discount rate, I think, will slow that economy down. I don't think the Japanese stock market's going to be that great in 1990.
You think that if not 3 steps and a stumble, at least it won't be 3 steps and a jump even higher?
Minimum, it won't be that, yes.
Marty Zweig, what do you think of this bond market? Because it seems to have troubled some people this week.
Well, the good side of the bond market is the weak economy. I think the economy really is weak, Lou. And most of my indicators in that model measure the economy or inflationary expectations, which are quite positive for the bond market. The bad thing, as Frank said, though, is the dollar. If the dollar gets weak, it should hurt the bonds. The other problem is the optimism in the bond market. The mutual funds cash-to-asset ratio for the bond funds is near a record low right now. There's too much optimism in the bonds.
How much weight do you give to that idea that if the crowd believes something has to be wrong?
Well, I give it some weight. In my stock model, it's about 1/4 of the weight, and in the bond model, it's 15 to 20% of the weight.
Is there too much optimism in the stock market?
No. As a matter of fact, the cash-to-asset ratio for the bond funds is about 12.4%, one of the highest readings ever, and my sentiment indicators on stocks are about neutral right now.
A while back, you were keener on bonds and stocks. Have you now switched?
I'm about the same on both, moderately positive on both stocks and bonds right now.
Mary Farrell, what's your mood as the year comes to an end?
Reasonably optimistic if you can look ahead through 1990, but I think we have to be very aware that the worst is yet to come in terms of corporate earnings. Now, the market has gone up tremendously in 1989 despite decelerating earnings, but I think the worst in the first quarter, we're liable to see S&P earnings down as much as 20%.
Since it's not one of the predictions that we'll get to later in the program, let's stay with this bond market for a minute. What's your prediction on long-term rates?
I think rates are going to continue down. I think the long rate will see at least another percentage point, and that should be very positive for bonds. Short-term rates are also likely to come down even more than that. That creates an attractive environment for fixed income.
How about the point Marty makes that too many people agree with what you just said?
Well, I think one thing that when you have attractive rates in the bond market, and particularly when you're talking high-quality bonds, it always presents a very good alternative for conservative investors, and I think you'll see a response to that. You'll see people buying bonds.
Monte, go ahead, and what's your status as the year comes to an end?
Well,
aside from vigorous, handsome, and effective.
apart from that, we don't have to deal with that. That's an acceptance. My attitude is that you're going through essentially a cleansing process as far as the market is concerned. You're busy taking out a lot of the things that the market didn't like. doesn't like speculative risk. It hasn't liked inflation. It hasn't liked the circumstance of uncertainty with regard to the recession. And I think those processes are being dealt with. So I think what you're looking at is the building of what will be a more favorable stage. But I certainly agree that the next few months are going to be kind of unhappy and a little bit dangerous, because there will be a number of surprises. Corporate earnings, as Mary has mentioned, and some other things that could happen. But I think the market is basically correcting a lot of the things that we found unsatisfactory as 1989 closed out.
I want to hear more about this cleansing process. I mean, is it cleaning up or cleaning our clocks?
In certain stocks, they cleaned our clock very beautifully. But in other cases, I think it's a process that the market has done something that says when illusion met the reality, then the market began to deal with the problem. What you're seeing in the junk bonds, what you're seeing in the condition of LBOs and in the higher quality as far as value is concerned, is a recognition that certain levels of speculative risk are unacceptable. Cleaning those out, I think, puts the market on a better basis.
All right. Now, this is the point in the program when we normally pause to answer a round of viewer questions. Tonight, though, we're going to use that time to ask these four whiz-bang panelists the biggest question of all. Where are you guys putting your money right now? But next week, we'll be back to business as usual. So on the off chance that your every financial need has not been met by them tonight, drop me a line at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we look ahead, let's see where we've been as we review 12 months that were supposed to see the end of the great 1980s bull market, but somehow didn't get the word. The Dow Jones Industrial Average has had better percentage gains in the past, but it has never even come close to gaining 584 points in a year. The previous record, set in 1986, was 349. And while the blue chips led the way, all the indexes scored advances that were strongly above average. Despite their feeble bounce near year-end, precious metals continued to tarnish, with both gold and silver losers on the year. The dollar had a mixed year, but was generally huskier than expected, especially against the Japanese yen. Instead of falling to a mere 100 yen, as had been portentously predicted, the greenback soared 15%, and at year-end was buying nearly 144 yen. Tonight, this being the end of the 80s, we thought it would be interesting to show you the record for the entire decade. It is, as you see, quite a story, with the Dow up nearly 2,000 points in 10 years for a 228% gain. All the broader stock market indexes also more than tripled. But woe to those who were taken in by the so-called hard money addicts. Gold lost nearly a quarter of its dollar value in a decade when consumer prices were rising more than 64%. But even that was a relative bonanza compared to silver, which high-hoed to an 85% meltdown. The dollar never quite recouped the losses that were foisted on it by, among other people, its own government, though it did manage to stay well ahead of the British pound for the decade. Meanwhile, the U.S. economy, despite a sort of rolling recession that hit first one area then another, continued to grow overall. In November, it began an unprecedented 8th consecutive year of peacetime expansion. And over the past 4 quarters, total U.S. output continued to confound the doomsters, expanding by a healthy 3.3%. But the nation worried more about inflation this year. In May, it reached its highest point in more than 7 years. Despite some cooling since then, for the past 12 months, consumer prices rose a still disturbing 4.7%. Unemployment reached a 16-year low of 4.9% in March, but has lately been creeping up a bit, reaching 5.3% in November. As for short-term interest rates, the benchmark prime was raised twice this year, then lowered twice. It ended the year exactly where it began, at 10.5%. Yet, interestingly, long-term bond yields are a good deal lower than they were a year ago. Today's yield on Standard & Poor's index of long-term Treasury bonds is 8.17%, more than a full percentage point lower than a year ago. Hearteningly, the nation's trade deficit continued down for the second straight year. While the nation has not seen a monthly trade surplus since April of 1976, a mind-boggling 161 months, the deficit for the first 10 months